Welcome back to Good Returns. I'm Matt here with Garrett. This is our May Monthly Roundup. This is episode where we take a step back from the weekly noise and ask the bigger question: what actually happened? What does it mean? And what are we watching now that we're entering into June and May is over?
Yeah, May is a good month to do this on, to step back and look at, because we have some headlines flashing, which are that you have records across the board. The S&P 500 is up more than 5%. Nasdaq up more than 10%. Looks like a fantastic month, and in a lot of ways it was. But there's a question underneath all that we're getting from clients and people, asking.
Mm-hmm. And prospects, people that just call in and talk and look at their 401k and things and have questions.
Yeah, there's a question that people are sitting with that we don't think they're getting a very clear answer on. So we're going to try to do that in this episode.
Yeah, it's really when you see a certain index or the media saying something's at an all-time high, but your 401k doesn't feel like it. Your portfolio doesn't feel like it. And so we're going to talk about the nuances of that and why that is not a bad thing, and the principle of diversification and uncorrelated asset classes and what that means for not what is happening year to date in the market, but what's going to happen 5, 6, 7 years from now. It gives us a good framework and a structure to keep compounding at the rate that you need, and then exceed those expectations along the way.
Yep. So before we get into it, everything on Good Returns, as always, is for educational purposes only. Nothing we say is personalized financial advice for your situation. We are here to give you context, help you think more clearly. We may or may not be your own financial advisor. If you figure that you like what we're talking about, you hear some things that make sense, or questions that you have in your own mind that are being answered, feel free to reach out to us. We'd love to start a conversation with you.
Yeah, let's look at the numbers. S&P up 5%, a little over 5% for the month. Nasdaq 10%, building on April's 15% gain. Now, this is on the back of the drawdown that occurred
the beginning of the year.
Yep, at the beginning of the year. The Dow, Russell 2000, and equal weight S&P did in fact hit new all-time highs too, but returned lower, between 2 to 3%. Now, technology, big tech was the difference, rising nearly 20% in May. Strip that out, the rest of the S&P was negative.
Yeah, and this is really the story of May. The gap between that headline index return that you just talked about and what most other stocks and sectors returned, and by most we mean most of them, in the most of the tradable stocks, that was the difference, and that's the story that we're going to spend a lot of time on in this particular episode.
Yeah, absolutely. Oil did fall more than 13% in May as the risk premium unwound. That did pull yields lower. Eventually, yields did go lower. Gave the AI semiconductor trade room to run. Now, the 30-year Treasury did touch levels not seen since 2007, kind of halfway through the month, but then settled back down as oil, in fact, rolled over.
Yeah, we also had Jerome Powell's last month as chairman, Fed chair, and that ended in May. Kevin Warsh took over. Credit markets stayed, broadly calm for the most part. Corporate bonds outperformed treasuries. Again, like you said, spreads tightened. One notable crack in the lowest tier of high yield bonds, where spreads widened. That area is kind of worth keeping an eye on.
Yeah, very interesting. Could be, I doubt it. At this point, doesn't appear to be anything systemic. It may just be related purely to niche parts of the high yield market that are, those junk bonds correlated to various different software companies and things that are having some pressure.
Yeah, I think there's some misunderstanding there about what high yield actually is, and it's called junk bonds sometimes, but it is very low rated bonds because it's where you have the most potential for growth in that bond sort of sector, and it acts a lot like what we see from time to time. Is it acts a lot like an equity actually on those high yields, but it's there are specific parts of the year where it's an interesting kind of spread to watch. Yeah,
and that's the scoreboard. Strong headline, narrow story underneath. Let's unpack it. And, let's start with the question that we kind of spoke about at the intro, because I genuinely think it's one of the most common things that investors are feeling right now. It reminds me of 2017. And most people aren't getting a straight answer to it. And that is when you hear that the S&P is at an all-time high, and the headlines say the market is up, but you open your account and you're like, oh, well, I don't feel like I'm up or up that much. So kind of, what's going on?
Yeah. The first thing you have to understand is what the market actually is when people say that. And a lot of people have different metrics for that, but most of the time you're talking about the S&P 500, the number you see on the news. It's not an equal representation of the 500 plus companies. There's more than 500 companies in the S&P. It's weighted by size. And so the bigger the company, the more influence it gets on that index number.
Yeah, and right now, a small number of very large companies have an enormous amount of influence. The biggest tech names, companies like Apple, Microsoft, NVIDIA, Google or Alphabet, Meta, Amazon, make up a significant share of the S&P 500. So when those companies go up, which has been kind of the rebound trade since the pullback earlier in the year, that index goes up, even if the other 490 companies are flat or down, which is what we saw. Mm-hmm. So you're basically dealing with...
And we've seen it before.
Yes, we have seen it before.
The Mag 7, the notorious Mag 7,
yeah.
When people were talking about that.
Yeah, and so you end up where when you look at the S&P equal weight, the S&P 500 that the news generally refers to, that is the equivalent of having 50% of your portfolio in 7 stocks and the other 50 in 490. And that's not necessarily a bad thing, but the problem is when you have as much volatility introduced into that market-weighted index as we have seen, you start to realize and understand when you look at the charts how such a big pullback can happen in an index of 500 companies, because you would think, oh my God, how can 500 companies all go down? Well, now you're seeing how these significant pullbacks can happen when you think that you're in an index, because you're really 50 to 60% of your money is actually not. It's in just a small sleeve.
You've had this is sort of a recent development where these certain companies have made up this. It's actually a lot of people are concerned about this. The amount of the S&P that are made up of these companies. There's a lot of people asking, is it appropriate to have them represent this much of an index that, to your point, is supposed to be a diversified index that somebody, just starting out can go throw $100 a month in an S&P 500 fund. And honestly, it's still not a bad strategy. Yeah. But you just have to understand what's going on beneath the surface. You can look at, there's another version of the S&P, we talk about it a lot, the equal weight S&P 500, where it holds the same number of companies, it holds the same companies, but it gives every single one the same weight regardless of their market cap. And so Apple counts the same as a smaller company that you may have never heard of. In May, that regular S&P 500 account, as you said, returned about 5.3%. The equal weight on the other side was about 2 to 3%. So the same companies, very different results because of the weighting. The difference is entirely explained by how much the largest technology stocks moved. And then I know that, the more interesting part is if you take that out altogether, I think that what do we have? Like a negative return if you remove the tech stocks altogether from that index.
Yeah, it's very interesting. We have come over the years to appreciate the equal weight for what it is, which is a better representation of a long-term market return. It's a much better target, and it's a healthier way to anchor the portfolio, in our opinion. And just mathematically, it seems to be the case. But that the concentration risk that is there, and it is risk. It doesn't mean that these Mag 7, Mag 8 may very well become even more a percentage of the S&P. Their market cap may increase beyond imagination. It's very possible. In fact, it's probably more possible than it is not. You could argue that with the very optimistic outlook of the AI spin, the AI race. But there's risk to that, and you have to understand that. So when you're looking at building a portfolio, or even in your 401k plan, you're going to be diversified. And so you're going to probably have 25% of your portfolio may mirror the S&P. You may have 25% that's in small cap. You may have 25% that's in international, and you may have 25% that's in bonds. So what that means is that during that quarter, when say the S&P is up 6%, and you look at your portfolio and you're only up 1% or 1.5%, well, it's because you had small cap, international, and your fixed income that didn't perform, but that 25% that mirrored the S&P did. Mm-hmm. Now, you take that as a win because you want that portion of your portfolio to do its part. But there's a flip side to all of this. Right? There is a 180 degree. There is a what happens tomorrow situation that occurs with aspects of your portfolio. And
well, you also saw this with international at the beginning of the year, where you had international exposure and emerging markets exposure actually beating the S&P 500. And a lot of people are scratching their heads about why that's happening. So it happens in both ways.
Yeah, it does. And, think about the first quarter. The market sold off 10%, but it was not evenly distributed. And we saw that in the advice that we give and the portfolio allocations that we do. We didn't take it on the chin for that short period of time because of the diversification and the way that we're very tactical in how we allocate. But the most concentrated positions, the names that everybody piled into, such as your NVIDIAs and your Apples, they fell the hardest.
Yeah.
So diversified investors had a cushion.
Yeah, that's the trade-off there. A concentrated index outperforms on the way up and really underperforms on the way down. A diversified portfolio gives up some of that upside in the concentrated rally and gives up less of the downside also when the rally reverses. And so for most investors with a long-term plan, that is actually the right trade-off. And that's the right way to frame that conversation in your mind. And it doesn't feel comfortable in the moment. The other side I would say to that is that it's the importance of coming up with a plan for your own investments, whether those are retirement funds or funds that you need to use in 5, 6, 7 years. You need to know what your goal is for those investments, because it's a rat race to constantly chase like a headline number. I'm always behind the S&P 500, so I'm always feeling like I'm not doing what I should be doing. I'm always failing because I'm not, exactly what this number says. When in reality, it's not the case, because you may not need the S&P 500 return. Like you may be fine with lower return than that. You may need more than that. I mean, it's just, you have to know your own situation. And that's the other part of this that we're not really hitting on right now, but it's sort of both of those work hand in hand together.
Yeah, they do. And let's just very briefly speak on a few of the different asset classes that are underperforming, that are great diversifiers. And it's actually a really, really good sign to see them not going up when everything else is going up. And two things that come to mind immediately are Bitcoin and gold. Bitcoin in particular, when you look at
both asset classes, which have had a really good run up in the past. Well, I mean, Bitcoin's been in an elongated downturn, but gold has we were talking about it all last year.
Mm-hmm. And you look at the decoupling, I guess is what you would call it, because for quite a while, Bitcoin and the Nasdaq were tied. And so your algorithmic traders were, any time that they would place a trade for risk on Nasdaq, it would risk on Bitcoin. And that's what was driving that trade. And long term, it wasn't like that before 2021. And it was like that from 2021 until October of last year in 2025. So we're getting back to where it is becoming an uncorrelated asset. And that is extremely bullish for that space, because the value creation and the narrative of why you hold that asset is decoupled from the tech narrative. And that drives institutional adoption, and it drives people to begin to allocate to it, because you want to see a high beta, high returning asset class that is not correlated to the Nasdaq or the S&P, because that is golden. Because that means that you end up in a situation where you have more levelized, high compounding growth over time without the same whipsaw effect of my gold or my Bitcoin go down when S&P, and my gold and my Bitcoin go up when S&P. It's very, very positive to see that decoupling that's happened to where, S&P and Nasdaq are going up and Bitcoin is going down, because that script is going to flip. And when it does, you're going to be very, very grateful that you are allocated to uncorrelated asset classes like that. And I could go on and on and on, but it really is
Well, that's the argument that a lot of people also use for like REITs, like real estate investment trusts. That same sort of uncorrelated argument. It's a little bit different there in that case, because a lot of those can tend to be
there's interest rate sensitivity.
Well, that too, but a lot of them may be non-public, non-publicly traded, or very illiquid. So you just have to be careful when you're looking at non-correlated asset classes.
Yes, you do. You do. They're not all created equal, for sure. But the blockchain narrative and Bitcoin itself, I just want to let everybody know when you're looking at the news and say, okay, well, Bitcoin's down again. It's still at a high number, but it's down. It's not performing like the other. You just need to keep in mind that this event, this decoupling of Bitcoin not becoming a proxy for the Nasdaq any longer, is an extremely positive sign, and it shows that, especially from an institutional perspective, there are now independent drivers of Bitcoin's value, just like it used to be. That's what really got it to $1 trillion asset class to begin with, was the value under the hood of what is being done and what is being created with these asset classes, these blockchain technologies. So very bullish. It's extremely bullish. I don't like to come and make hardcore predictions and really plant my flag unless I'm extremely confident in something. And last time I'll say it for the podcast and then we'll go on to other things. But seeing this decoupling that's occurring shows maturity of the asset class, not weakness. And it shows significant opportunity that will benefit those that are patient and hold through and are okay seeing the S&P or the Nasdaq hit all-time highs while their blockchain technology positions or their Bitcoin positions don't, because it paradoxically, and it doesn't seem to make sense on the surface, but for that to be happening is a very, very positive sign. I think the only thing I think we need to see next is the broadening of the rally back again, like we had started to get very early in the year. But if we can
got it a little bit last week too.
If we can have, and I guess yesterday was kind of a flip out of.
We did flip, halfway through the day. That is true. Yep.
So that's a good thing. So I think that if we have this foundation being built where we have uncorrelated high beta asset classes are back in the game. And
explain what you mean by high beta, because I'm sure people listening to this don't know what you're talking about.
So if you think of, we can use an index, it doesn't matter, just a grouping of stocks that are going to, say, go up 5% for the year. And then let's say you have a grouping of a small subsection of stocks or a sector. Maybe it's the energy sector. Maybe it's blockchain technologies. Maybe it's real estate. And when historically over time, those small groupings outperform the index, when the index is up, that's considered high beta. It's a higher value add. You're taking not significantly more risk, but you're getting a lot more return for that. And so when you're seeing, again, higher value add, higher beta trades that are decoupling from the indexes with an intact value proposition and an intact structural bullish thesis, then it's really good for that asset class. It really is, because it can begin to get back to trading on its own narrative, not being used as a proxy for the Nasdaq. And I think that's healthy and that's good, because people need to understand that you're owning that asset class, and Wall Street is gobbling it up hand over fist, not because it's a stand-in for the Nasdaq, but it's because of the value proposition that it brings to the table. And we can go into that on a different episode, but it's anyway, it's good to say. I wanted to say that, but that's the reason when you're looking at these things and you're scratching your head and you're like, oh, my 401k is only up, let's say 2 or 3%, and I see this other position's up 7 or 8. That's okay. That's fine. Let the process work, because that script's going to flip, and you're going to be glad that you had a diversified approach so that you can get the returns that you need without having to go, wildly out there on the risk curve.
Yeah. Yeah. My goodness. Something in my throat.
That was an emotional
segment. Well, let's talk about earnings. We have talked about this in the past, but blended earnings for the S&P 500 coming in just shy of 29% for the first quarter. I think analysts had been expecting 13.1 going into the earnings season. So the actual result was more than double that forecast. And then you had profit margins hit a new record as well. So, it's a really confusing time. I mean, to be honest, it's just that, how do you wrap your mind around both of these things happening?
They're remarkable numbers. They're real. Corporate America is genuinely healthy in ways that are not getting enough credit. And it's some of the numbers we're seeing is kind of hard to believe. And those companies will be rewarded for that. Right now it's being overshadowed. Again, it comes back to, we got a handful of companies that have been driving the narrative here recently.
And the same thing with this. So if you remove those largest semiconductor companies from the technology sector, technology earnings growth gets cut in like half, maybe a little more than that.
Yeah. So replace everything I just said. We were talking about gold. We were talking about Bitcoin, Ethereum, kind of the very popular new age asset classes. But the same goes for not new. Yeah.
I don't know if that's the right word.
New age, technologically, the digital era.
Right. We got you.
Yeah.
Not a religious show.
But replace it. Replace those asset classes with industrials. Replace them with air conditioner manufacturers. Replace them with copper manufacturers. Just name anything that is building something. Replace it with that. The script is going to flip, and you are going to have the other 490 companies start to pull their weight if these numbers and the direction of earnings continues. Mm-hmm. And I'll tell you one other thing. I was looking at freight data 3 days ago.
As you do.
As I do.
Yeah.
So two elements: general freight data and flatbed freight data. And I was listening to
say that 3 times fast.
I was listening to the foremost expert on shipping in the country. He runs a company that most shippers use his analytics and his tracking. So he has like a 30,000 foot view of everything that goes on, and he constructs these heat maps. The darker the red, the more concentration of trucking activity. The lighter the red, the less concentration of shipping activity. Normally, what you see in economic expansion is you have the coast light up first as the ports bring in the goods. So think Savannah, think Los Angeles. It lights up, and then a few weeks later, those goods are moved throughout the country, and that cycle kind of repeats itself. Okay, so now shipping is extremely tight. Some drivers are being paid double, 100% their salary. And flatbed trucking is at a 50% reject rate, meaning that you have a 50% chance if you try to get something shipped to you on a flatbed is not going to happen. It's not booked. You can't book it. They're so backed up. And so take that into account and then look at the heat map now. We do have positive economic growth, but the coasts are light red. It's the center of the country, the Rust Belt, that is dark red. And what is happening in the Rust Belt is an actual manufacturing and industrial expansion that has really not materialized in well over 20 years. And it's actually occurring. And he was going into, different reasons, different possibilities. But the simple fact of the matter is, that shows the earnings that we're seeing from all of these companies that are not getting the headlines that NVIDIA, Apple, and Meta are getting are, not only are they showing blowout earnings, but the real economic activity that's occurring is measurable, and it shows significant amounts of equipment being manufactured, being distributed, significant amounts of raw materials, and the economic activity as measured by freight, which is extremely important because we're a consumer economy. Everything moves on trucks. The highest concentration of shipping is not on the coast, it's in the interior. And so that's really building the case like, hey, we have something really interesting happening with the economy. It could surprise to the upside in ways that could be the black swan. The black swan this cycle could be a positive black swan, that things are expanding and happening in ways that we don't really understand right now. And it will only be when we kind of look back and say, that was incredible. And I think I think the straw that broke the camel's back was the AI CapEx. I think that's what did it. And from that, everything else just began to fall. I mean, Caterpillar, John Deere is backlogged. The order volumes are insane. All your industrials, your HVAC units. I mean, it's just, Johnson Controls. It's just one right after the other. And I think it was
Why would that be?
Well, I think it started, everything has a big impact when let's say Google says we're going to build a $5 billion building, right?
Yeah.
You got to have a lot of steel, you got to have lights, you got to have plastics and copper and GPUs, and that goes to NVIDIA, and then NVIDIA has to pay, and it just jump starts. It's almost like a giant government stimulus, except from the private sector, and it just creates this ripple effect. And then when one company gets an order, well, what does Caterpillar do? Caterpillar, you got to flatten land where all these things are going. They're giant buildings, so you got to flatten 3 square miles or 4 square miles of land. So people, we need more Caterpillar bulldozers. Well, they got to get the steel. And so then they go to Nucor, and Nucor needs to buy the coal. And then you go to the coal. Well, to dig more coal, you need another Caterpillar. And it just expands, and we need air conditioners.
First the coal and the Caterpillar.
Yeah, it just keeps expanding. And, I don't have it all figured out. And I don't know everything, but I can tell you that when I looked through that data and had it explained to me, it matches up with what we're seeing with earnings. And it's incredible. And I think it continues to build the case that if and when we see a broadening out of the rally, that's where these diversified portfolios are going to get their just reward for their patience and prudence and having good risk return metrics, and targeting that long-term 5, 6, 7, 8, 9 year compounded rate of return, not just what's happening in a certain cycle, for just a few months or following a narrative for, 6, 8, 9 months. It's that discipline that's going to pay off. And one of those things that's going to help do that is, the rest of these companies, getting their moment in the sun, their moment in the spotlight.
Yeah, I mean, it's interesting because both of those things that you referenced, the earnings story and also the CapEx spending, are sort of, really strong bull case arguments for what we might see in the future, but they're also the bear case because if they don't hold up, then do we have problems? That might be, it could be a tailwind or a headwind. And so
it could.
What is it at any given point? It's, a genuine tailwind now. When could it be a headwind? So that's kind of the thing you just have to keep an eye out for. And we'll keep talking about it. We'll keep watching it. Yeah,
it's very interesting. And then, I mean, again, what are the odds of a $50 billion mid cap, going to $200 billion? They're probably a lot more than NVIDIA going to $20 trillion as well.
Yeah.
So, and you're going to see a natural rotation of capital. It's going to happen. You can take it to the bank. You're going to see that rotation of capital. I know we're running out of time, but we didn't really get into gold, but there's a very interesting bull case to be made as we begin to retest that 5,400 an ounce mark to see, what does the next phase of that mean? But a lot of very interesting things. This is a very healthy. Even though everything can always be improved, this is a very healthy market that is awash with opportunity. It's just that diligence, that patience, having a plan and sticking with it. Even if your particular stock is not the one that's in the spotlight today, or if your particular fund in your 401k is not the biggest winner today, you want to have that plan, you want to trust it, and you want to stick with it because that narrative is going to change and that script is absolutely going to flip, and you're going to be very glad you're at where you're at now.
Yeah, I would agree with that. The only thing I would say is the question is kind of how is it precariously healthy? Is that the way to kind of frame the market? Because you're looking at earnings and CapEx spending and consumer spending and all this kind of stuff that's propping the market up, but I mean, I guess you're always in this environment where something could flip and you could have the opposite be true. But I mean, yeah, all the data that we have supports the fact that we're in a healthy market at this point.
Yeah, jobless claims low.
Yeah,
job,
we had
job growth rebounded.
Some numbers about that this morning, I think.
Unemployment eased to 4.3. Manufacturing is back in expansion territory after a multi-year slowdown. Business activity is improving. And so all that being said, it's a genuine positives, and they matter. I would argue, the underlying business cycle is turning up. We're not late stage. I don't believe this is late stage part of the cycle. I think we are early to early mid. You don't get that type of freight data. You don't get expansion with the ISM if that's not the case. That's why I'm thinking.
Even if you look at historical bull markets, we're not anywhere close to what an historical bull market would have performed over the same kind of period that we're in. But you also have to look at the consumer. You got income growth slowing. Consumer confidence, which is extremely weak. One closely watched survey that we look at is near a record low. Household spending has powered U.S. economy for several years. Maybe it's starting to show some cracks. So that's a real thing too. You have to look at it from that angle.
Yeah, but that's good.
Kind of
that's a good thing. I'll explain why it's a good thing. And I'm going to bring it back to blockchain Bitcoin. Okay. When you're seeing risk on appetite across the board, and your blockchain technology portion of your portfolio is underperforming or down, that's showing you, okay, wait a minute, hold on. Now we're building a strong base of support here. So the next time we reach an all-time high, it's probably going to be gigantic. It's probably going to be much bigger.
No guarantee. Not guaranteed.
Yes, no guarantee. But it's probably going to be much bigger than you think it is and much bigger than it otherwise would be. So that builds the case. It's like, yeah, well, I'm excited now. I want to have a little bit. I want to have an allocation to something that's transformational and that has a historical 80% compounded annual growth rate. We'll cut that in half and just say it's 40. Like, yeah, you want to have a piece of that. So,
well, I think it also speaks to the sentiment indicators. Like, this is a different thing, but the sentiment indicators for Bitcoin or for consumer confidence or something like that, it's this whole idea that they're contrarian indicators, that they actually are signifying something positive, even though they're framed in a very negative way. When you see the flashing lights on CNN or the talking heads saying consumer confidence is weak and the Bitcoin has its own fear and greed gauge and it's all the way over at fear now. And so, yeah, if you're a technical trader or somebody who looks at that kind of thing, I guess you are kind of in your camp where you're like, yeah, this is actually a good thing.
Yeah, it's good. And I'm going to tell you why on this consumer.
Tell us why.
We are blowing out earnings. We are blowing out CapEx. We are blowing out expectations across the board, and the consumer is weak. So what happens when the consumer's not weak? Are we going to go down? Are companies going to make less money? No, they're going to make substantially more. That's what I'm saying. I think we are approaching an environment where it is a non-zero probability, and I think it's increasing with the day, that this cycle, this bull market's black swan, is actually positive. It's not negative. And it is some circuit breakers within the economy got flipped with this AI CapEx, and it has kind of primed the pump for expansion. So I look at that and I say, yeah, this is a good thing, because we're hitting all-time highs and the consumer is having a hard time. I want to see what it does when they have a good time, because we know this cycles. We know this cycles. You can chart this out. Consumer confidence, consumer spending goes down, then it goes back up, and there's credit expansion, there's credit contraction. That drives a lot of it.
I think there's a lot of variables that aren't fully fleshed out right now that would have to happen to make that the case, though. Like, I don't disagree with what you're saying, but I think that there are some other things that have to happen, particularly with all this stuff going on in the Middle East and the Strait of Hormuz and the oil movement and all this kind of stuff that would have to sort of flip, which is, again, when you look at best case, like bull case scenarios, that is one of them. That is maybe the main one, that everything kind of gets resolved over there.
Which it will. I mean, 5 years from now, it's going to be resolved. 4 years, 3 years. I mean, at some point it will be resolved.
Yeah, but I mean, you have the market thinking that it's going to be resolved. And this is actually, I think this is in here, but you have people bringing up now the fact that, has the market gotten it wrong? I mean, the market is pricing in an outcome, and we've talked about how it doesn't price in like possibilities. It prices in like outcomes, probable outcome, despite, everything, is that something that maybe the market's getting wrong. Maybe it's going to take longer than the market itself thought. And so you get into that whole conversation that snowballs into rate hikes and all these kind of things that derive from it. But it's a genuine question that a lot of people have right now.
Yeah, I think it's hard to second guess what the money in the market is doing, because especially when you're trying to diagnose a global issue and the impact it's going to have on the economies around the world, because there are so many data points that in real time you can understand what's happening, that I find it less likely that the market is getting it wrong, because there will be a resolution one way or another at some point. And it's just what happens, between now and then. What's the gap, and is it meaningful? As I stated at the beginning of this year, we were in a oil glut structurally, too much oil. Even with the disruption, you have the economies and the countries around the world have dumped enormous amounts of oil out of the reserves. The moment any incremental slippage, whether it's through short-term deals or whatever happens, and you get tankers out, it makes the reality of us still having an oil glut there. That may not be the end of this year. Maybe it's March of next year. So, I think that most people are missing with the oil situation is that we are not, even with this happening, we are not in a structural shortage globally. We are in a structural glut. And this is only making that glut bigger. Because when prices are elevated, everybody's trying to pump more out of the ground. More of the thing we said we had too much of at the beginning of the year. So I think that's why there's such resiliency. Could be wrong, could be 100% wrong. I'll take full responsibility for my wrongness if I am.
Write it down.
But that's how I try to and rationalizing it doesn't matter. But when I look at the market and I'm asking the question that you're asking to myself, it appears that that's probably the reason why. Again,
I think you're looking out long term, which is right. You have to do that, but also people are experiencing the effects of it in real time. The short term is affecting them more than what the long term would be. And so,
but that's a choice now.
Well, I mean,
it is, and it didn't used to be, but it is a choice now.
What's the choice?
Well, if you are affected by the change, the fluctuation of
higher gas prices,
or higher diesel prices, I would say for the majority, 75% of commuters, it is now a choice for the gas prices to bother you. It's not, you're not stuck with it. Because you can go get a different form of transportation via an electric vehicle.
I mean, it's not as easy as that though.
No, it is. It's very easy. They want to give them to you so bad they'll let you drive away the same day with it. It's a choice.
Well, I mean, it's not
everybody.
Theoretically, it is, but in practice, it
everybody
isn't.
that drives a vehicle is going to buy another one.
Right.
So,
I mean, eventually,
yes,
at some point.
That's correct. So,
but if you just bought a gas vehicle 12 months ago,
well, you made a choice.
Well, but you made a choice in a different environment.
It doesn't matter. You still made a choice. I'm just saying that it is different now, and I'm not ignoring the fact that some people are not going to be able to just up and trade a car in. I get that, but you will at some point be shopping for a vehicle, and you're now making a choice for gas prices to bother you. Gas prices don't bother me. It doesn't bother me in the slightest.
I mean,
I drive right on past it, and that's a choice that I made. So what I'm saying is there's a pressure release valve that is built into all of the economies, especially the Chinese economy, that did not exist the last time we went through all this nonsense. And so,
yeah, but both things can be true. I mean, it's not one or the other. Both things can be true. You can have a choice, and it also can affect your day-to-day life.
Yeah, I mean, you can to an extent. It can affect you. I was listening to this big real estate guy not too long ago, and he was saying something along the same vein of the choices that we make and how you can or cannot choose for certain things that are out of your control to affect you. And I just think on that because, if I'm Frito-Lay or I'm Pepsi or I'm Coke and I'm spending, $1 million a second on diesel fuel, and now there is Volvo and Tesla with the electrification of 18-wheelers. Okay, and I'm choosing for that diesel price to bother me if I don't buy those products. Because the moment you buy those products, it is irrelevant what the price of diesel is. It means nothing to you. And so it's an active choice. And I would just, if high gas prices are throwing you off your financial plan, then you need to stop worrying about high gas prices. You need to figure out a way for gas prices not to bother you. And I just think that it's rapidly, again, I use the Chinese economy as an example because they figured it out. They don't have hardly any oil in China. It's virtually none. Very, very limited amounts. But they consume, obviously, an enormous amount of energy. Well, what did they do? They said, we're going to cover the desert with solar panels. You're going to cover the whole desert. Ain't nobody out here anyway. We're going to cover it in solar panels. And we're not going to have to worry about they're going along just fine. And they're the ones that get the oil from the Gulf.
But how long did that process take?
It really accelerated after 2017. 2017, 2018 was really the beginning of everything from, again, covering the desert in solar panels to using reflective mirrors in the desert to have molten salt reactors, that one hour of that reactor running will power a family of fours in entire energy need for 50 years. And it doesn't require ships carrying a bunch of crude and doing all these things. It's just the sun. So I'm saying these are all choices. And when prices hurt you, whether you're a business or you're a person, you begin to make choices that are different. And when those choices are made, you do not go back. So when businesses make a choice, when UPS says, I'm going to buy the Rivian delivery vehicles, the moment they do that and there's no engine maintenance, there's no oil change, and there's no gas or diesel or compressed natural gas cost for that vehicle, they are never going to change. And so that is a structural decline in the consumption of oil that creates the oil glut that existed in January. It makes it worse.
I think there are catastrophic situations that could occur that would perhaps make them reconsider, but that's a thought experiment that's neither here nor there.
What are we talking about anyway?
Well, we were talking about consumer spending and consumer sentiment. I don't want to stay here the whole conversation. We're almost
we
to
have
our
to.
time.
We have to stay here now. I'm drawing a line in the sand. What
think
choice are you going to make?
Yeah. I mean, it's a nuanced conversation. It's people can weigh in on it if they want to.
It is. You're right. And it's a little bullheaded to lay it out that flatly because there's a multitude of reasons.
Well, I think that it all goes back to the fact that when you look at things, it's not a negative thing, but when you look at things, you have a tendency to look further out than most people do. Most people live right here within the next week, the next day. Like, what am I going to do tomorrow? And you're seeing it out, which obviously because of your job, you see it out much further than that. And you see the ramifications of that because over the past 13 years, we've worked with clients and we know it to be true that the long-term wins every time.
Every single time.
It doesn't matter if you have a negative 22% return one year and a positive 5% return the next year. They all weigh out over time. So we see that. We have the benefit of seeing that. But if you are someone who's not in that situation, that doesn't necessarily have that benefit of seeing it because you're just living, right here day to day, it's a much harder conversation for you to have with yourself. And it's a much harder decision to make, even though you may have a decision to make. It's just a harder thing to do.
It is. And that's why you need to reach out to somebody that can help you, whether it's us or whether it's another trusted advisor. You need to offload that worry to somebody that is thinking 10 years out from now. At
least somebody to bounce ideas off of and bounce concerns off of.
One of the big reasons that me and you and our firm and Mary Sarah, hello, Mary Sarah.
Shout out Mary Sarah.
Yeah. Have been trusted and we become very successful in doing what we're doing. One of the main reasons is because when we started this business, we were on the younger end of
I think we still are.
We still are, but we were and now are on the younger end of the age spectrum of advisors.
Right.
And that was very, very important to our clients and is very important to our clients because they have a high degree of confidence that we are thinking about the next 20 and 30 years. We're not thinking about retirement when they are, right? Our retirement's going to come long after, right? If ever. I'll probably just die here at the microphone. But that automatically, because we're not, next week is irrelevant. Next year is irrelevant to us. We are thinking big picture. We are thinking, what do our clients' portfolios look like in 5 years? That's why we can take and place a 5 or 6% allocation to Bitcoin or Ethereum and not blink when it changes in price. Because we have done the research, we're paying attention to the data. We look out and say, okay, this is early adoption level type stuff. And so when we do these calculations and have a high degree of confidence in the trajectory of these asset classes, if you can take 5% and turn it into a multiple of that, because you're participating in this new economy and this new digital asset, it doesn't matter to me if the price goes down 5% or 10%.
Well, it's that now, but it's the overarching theme is, it's not just concentrated in the digital asset space. There's going to be something that comes along in 10 years that's something that we probably can't even fathom right now.
Or it could be something boring like you mentioned high yield bonds. There have been periods of time over the last 20 years where high yield was the top performing asset class. So you could be led, the data can lead you to say, you know what, maybe we need an 8.5% allocation to high yield because we're looking at our momentum indicators, our technical indicators, we're looking at our quant metrics, and it may be, we need that. Because in 5 years, we're going to get such a multiple return that it allows our clients to not have to take so much risk.
Right.
And they can have that beautiful endowment level type return that compounds, slow and steady wins the race, and gets them to their goals without, having to just take what the S&P gives you, so to speak.
Yeah,
we've gotten off on some rabbit trails.
We have gotten
today,
off on some rabbit trails.
We're gonna
pivot to the end of this. One thing I do want to flag before we get to sort of the bull bear scenarios that we're going to talk about in a minute, connects kind of to the concentration conversation that we had earlier. And it's just the simple fact that institutional investors are kind of positioned at their highest equity exposure since late 2024. Inflows into ETFs have been huge. You look at Vanguard's overall market index is reaching the highest level it's ever held. The VIX is somewhere near 15 or 16. Credit spreads are tight. Almost every measure is telling us that the market is in a confident, optimistic posture, just what you said earlier. And it's fine, when things are going well. The concern with crowded positioning is what happens when something surprises to the downside. Yeah. When we have, earnings not hit where they want to hit, when we have CapEx spending not come in where it needs to come in. So when most investors are leaning the same way, when they're kind of overly concentrated in certain positions, it doesn't take much to trigger a rush for the exit. So the crowded trades kind of unwind fast. It's not a prediction. We're not saying that we have a dog in this hunt, but we're just saying it's worth understanding. So when positioning is one directional, the market may have less cushion.
It could
to absorb bad news.
But this is where I guess the dog that we do have in the hunt is we are much more diversified than the S&P. We are anchored more towards the equal weight. Than what you would expect in your 401k or in...
Well, in the 401ks, that's really hard to do. Most of the times you can't do that. I mean, we have...
Well, I'm thinking of your target dates that most people are going to be in. That's target kind of dates. What I'm thinking. But we are more anchored to the equal weight. And so that diversification it's not a guarantee because you don't know how these things play out, but it can provide you a cushion, which is what we saw during March, provide you a cushion and a better risk reward when those eventualities occur and you have crowded trades unwind and you have people that are saying, okay, I'm taking my profits in my Mag 7, these big hedge funds, and now we're going to we're going to go into different companies. So I would just say that I guess the only dog we do have in that hunt is that we are more anchored towards the equal weight. And our belief system is becoming increasingly more confident in that being a very solid, structurally sound way to grow and compound wealth, as anchoring the portfolio towards that.
And it is, because when you look out over a 30, 40-year period with the S&P 500 that's equal weighted and market cap weighted, return is not that different over that period of time, the longer term period. But let's move into the scenarios.
But your dividend is higher. Your dividend distributions are higher.
With the market cap?
No, with your equal weight. Generally, your equal weight's going to give you more dividend yield, which we don't really pay too much attention to, but it is a nice little extra to show up in your portfolio. I mean, it is nice to have. Yeah.
So let's talk about what we're watching in June.
Well, we have Warsh first press conference. Mm-hmm. Fingers crossed, hopefully the resolution of the Strait of Hormuz situation, and really what happens with consumer data. Am I going to be right and it flips with the oil narrative to the upside, giving fuel to the fire of the bull market? Or, as you were kind of speaking about earlier, do cracks show up, and then what does that mean?
Yeah, we have an earnings argument too, the earnings story, spending story. All these things are very bullish in nature for kind of in the future and what we're looking at on the positive side of this. Now, if we look at the bear case, the strait is still closed. Naval blockade is still in place. The rally has been pricing in this kind of resolution for like 3 or 4 months now. And at some point, if the resolution doesn't arrive, we talked about it before, is the market going to have to reckon with that gap between what it priced in and what actually happened? That's the concern. I mean, it may materialize, it may not, but that is something to watch closely. Concentration risk, S&P 500 at all-time highs. Most of the sectors flat or slightly negative. Crowded positioning and a handful of names. So again, that's a setup that looks kind of stable until it isn't. If any of that sentiment around that trade shifts, that could potentially be something we would see in a bear case. So
it hit that market cap weighted, for sure. I think the most important thing, again, beat a dead horse, watch that consumer data. If we see that consumer data surprise to the upside, especially on the back of the reversal in oil continuing, that's really good news. It's very good news. But definitely, it was a record month. We have these variables to pay attention to, but I think the big takeaway here is the market rewards patience. It rewards having a plan. In our case, it rewards having a very well-constructed, thought-out, diversified portfolio that gives you exposure to large cap, mid cap, small cap when it's appropriate, international when it's appropriate, blockchain technologies when it's appropriate. Have the plan and stick to it. Let the process play out. May is just another month that has come and gone, and it proves that, coming out of that March decline, you have a plan and you stick with it. And we believe that's how you are ultimately successful in this space is, don't hesitate. Plenty of radio personalities, whether it be Dave Ramsey or Susie Orman. I said Susie Osman. Susie Ozzy.
Susie Orman even still around?
I don't know. But when you think about kind of
showing your age,
those that made a name for themselves in really democratizing financial advice,
personal finance,
personal finance, and getting you to think. Right, everything they say is not going to be applicable to your personal situation, but it gets you to think. And draws back to the 4 food groups of Dave Ramsey or the different allocations of the 60-40 portfolios. You find your plan, whether it's with your advisor or with your 401k, you stick with it and you let the process work out because that's what's going to make you most successful. That's what the endowments do. That's what the large pension funds do. That's what the insurance companies do with the premiums that you send them for your homeowners, your life insurance, or your car insurance. They're not going into crowded trades. They're not just, finding the hottest name and then hitting with it. They have a methodical approach that they're spread out against multiple aspects of the stock market and the economy. They change those based on data, and they stick with assets for the long term.
Yeah. Well said. Well, this has been This has been an interesting one. I think we went a little bit long, but we will call it there and come back next week. Next week we'll just
My
have
coffee
another,
must have been strong today.
Yeah, I guess so.
I'm ripping and raring to go.
We'll have another week next week where we'll come back and just do the weekly. This is kind of more of a monthly thing where we talk about the whole month. But that's kind of good returns for this week. Thanks for spending time with us on the monthly roundup. We'll be back next week with a full breakdown of Warsh's first press conference, whatever the next chapter of that story looks like. And subscribe if you haven't. Share with somebody who you think would find value in it. Let us know in the comments if you disagree. If you agree, what do you think?
Be
and
nice.
Be nice.
Always be nice.
And we will see you back here next week.
Yeah. Take care.
Bye-bye.